Good afternoon, everyone. This is Kathy Neifeld with Agency One. It is 12 o'clock, and we are going to start this webinar at 12:02. We have a lot of people that are trying to dial in and access the webinar. So if you will just be patient, give us 2 minutes, and we will start when the clock turns 12:02. Thank you so much. Hi, everyone. Again, this is Kathy Neifeld with Agency One. We're going to be starting in 1 minute. Okay, good afternoon. This is Kathy Neifeld with Agency One. It is Thursday, July 23rd, and I am thrilled to be bringing you a presentation today with our friend Chris Kaplan from Equitable. Chris is a member of the Equitable Life Distribution Management Team and a vice president of the specialty markets. As head of the specialty markets group, Chris, along with his team, is charged with growing and managing key strategic life initiatives such as COLI, premium finance, foreign nationals, and pro athletes and celebrity programs. Additionally, the specialty markets group is positioned to help advance future breakthrough strategies for Equitable. Chris is a well-known speaker in the industry and is extremely sought after. We are thrilled to be bringing him here to you today, and he is going to discuss planning strategies associated with life insurance as an asset class. Chris, I am going to turn it over to you because I don't want to take up any more of your valuable real estate. The only thing I would like to remind the folks that are on the phone is if they have any questions, please type them in the question box and we will address them in the order that they come in, either during Chris's presentation or we will save them to the end, depending upon what the question is and where it fits into Chris's presentation. So without further ado, Chris, take it away.
Kathy, thank you very much. And it's an honor to be here and present another version of my life insurance as an asset class for your folks. So I'm going to jump in. As was mentioned, this is all a development around life insurance as an asset class. And I always start these presentations with sort of emphasizing that the concept of life insurance as an asset class is not new. I didn't invent it by any stretch of the imagination, but what I've tried to do over a number of years is to bring a quantitative framework of life insurance as an asset class, and more importantly, to start to figure out how to speak the broader investment management speak and bringing in life insurance and its underlying value in a broader portfolio of other asset classes and what it can actually do for investment managers, portfolio managers, private wealth managers even, and even institutional investors as well, because I firmly believe having the CFA charter and kind of thinking in that mode is that we use different terminology in a different way to explain our value proposition when it comes to life insurance. And that comes as a struggle. And I've seen that struggle. Some people are having a huge amount of success doing it qualitatively. My attempt here is to show different ways that I think quantitatively we can bring the conversation of where life insurance could fit in certain portfolios and what value proposition it brings to the broader portfolio and the diversification of the portfolio. So a couple of key tenets as we jump in, and these are critical to keep in the back of your mind as we go through these, because this is arguably the kind of groundwork, the foundational elements of why I think life insurance as an asset class has a place, and why this conversation I think is so important, especially now when a lot of portfolios are being rebalanced, et cetera, to think about this as a value proposition. So first and foremost, when I talk about life insurance as an asset class, I am talking about the death benefit, the ultimate payout, and the uncertainty therein of when that payout occurs. I'm not talking about the cash value. There have been a number of studies out there over the last 10, 15 years that focus on the cash value as the underlying value of the asset class. I'm focusing, and everything I do is the quantitative assessment and the portfolio diversification potential has to do with the death benefit. Now, we know that they are intrinsically linked in a manner of speaking, but I want to make that very clear up front. The second part, and this is probably the most aha moment, and you know, most people already recognize this, but I want to be able to define this in a quantitative framework, is that life insurance death benefits are uncorrelated with traditional asset classes. They're not negatively correlated, which would be ideal, but they are uncorrelated. And the important aspect here is that we know that correlations between different asset classes are not static, right? We saw in late February to middle of March, we saw correlations between stocks and bonds and most other asset classes all go to 1. Recall that correlations are ranked, if you will, or calculated from in a range of +1 to -1, with 0 being completely uncorrelated, meaning there's no relationship that's definable between the two asset classes. And I think that's very, very important, because as other traditional asset classes have varying degrees of positive, negative, or in some cases, spurious uncorrelated relationships, the problem they all possess is that when liquidity gets sucked out of the market, a lot of asset classes go down at the same time, making it very difficult for diversified portfolios to operate as intended. Well, the beauty of life insurance death benefits is that they are uncorrelated, because the determinant of when they pay out, namely the underlying mortality risk, if you will, or the propensity or the likelihood of when someone's going to pass away for that death benefit to pay out, will always, so said differently or oversimplistically, when someone's going to die has nothing to do with where we are in the different stages of a market cycle. And the fact that that uncorrelated relationship exists between life insurance and other traditional asset classes is immensely powerful when you try to build long-term diversified portfolios, because you can always rely on that relationship to stay static, something that doesn't exist with other asset classes. So mortality risk is uncorrelated to market risk. Thirdly, the IRR on death benefit at whatever time of your choosing, because you have to set an initial expected return. What do I expect this asset class to return? Well, that's a determinant of when we expect someone to die. And we know that there are statistics, actuarial data that can tell us probabilities of when things can occur. But on one singular individual, we just don't have that level of certainty. And we'll never do so. But we do have to set the stage up front if we're going into this in a quantitative framework. So we have to define the initial expected return on the asset class of when do we expect that death benefit to pay out. We can always adjust it going forward, but that's the starting point. And so IRRs on death benefit, cash flows coming in, namely premiums, and then death benefit at some amount in future points in time, you know, make a judgment call on when that is, if it's age 90, 87, 85, 95, whatever it may be. The IRR and death benefit defines our initial expected return. Next, life insurance death benefits, and this is the other critical component beyond the non-correlation to other asset classes, which I think is the most powerful element. But the second most powerful element, and probably just as important in portfolio construction, is that life insurance death benefits as an asset class exhibit very low annualized standard deviation. And we'll see this in a moment. It's similar, in fact, to cash and short duration government credit. And immediately, hopefully, brains are kind of turning on the idea that, well, if there's a very stable IRR glide path or an expected return outcome irrespective of whether someone's expected to die at 80, 85, 90, 95, right? The glide path of the IRR and the expected return is very smooth compared to other asset classes. And so that generates a low standard deviation, a higher degrees of confidence of achieving a set expected return over long time horizon. And that's immensely powerful when you combine a fairly strong return after tax type asset class over long time horizons, knowing that there's uncertainty of when the event is going to occur, the payout and the death proceeds are going to be paid out, and how you combine that asset class with other asset classes, knowing also that that asset class is not going to be correlated to the other asset classes in the portfolio. And last but certainly not least, asset class suitability review is absolutely critical here, right? Because, and we go back to the point of life insurance death benefits as the asset class. Well, clearly, if the death benefit and the payout therein is its main value in the portfolio, financially speaking, then it's critical that we understand where this type of asset class fits, because it will not fit in every single portfolio out there. Saving for retirement, expecting payouts on life insurance death benefits on a policy on your own life clearly is an obvious no, right? But there are lots of places where this does fit, where time horizons are, investment time horizons are substantially longer than what, you know, clients' mortality or life expectancy expectations are. So some numbers here, and I am fairly technical, so hopefully people follow along. What you're looking at here is a sample, run of different ages. So this is not one illustration. This is one run at age 20, 25, 30, 35, etc. And based on using a 2017 CSO mortality table, what the life expectancies are on a male standard at these different ages, using our at this point, equitable IUL Protect at a 50-50 blend for those that want to know. But the importance here is not which product I'm using or how I'm funding it, because the variation in expected IRR at life expectancy or even the standard deviation is not going to, become vastly different whether you're funding it as a 10 pay, level pay. And I think that's part of the power of this as an asset class, is that you still have all those choices in terms of which product to use, how to fund it, what the expected crediting rate is on that policy, et cetera, et cetera. I think the fundamental power is the chassis itself, the life insurance policy, whether it's a whole life, UL, GUL, IUL. There are some issues I have with standard kind of variable universal life, because your investment allocation inside those tend to be correlated, perfectly correlated with more traditional asset classes. But all the other types of chassis work extremely well under this. So let's dive in here. And I'm not going to go through the entire standard deviation methodology here. That's a prior presentation, but take my word for it that it's been vetted by finance professors, et cetera. And that I'm not saying that I'm 100%, definitively right here, but I think it tells an important story, is that we have, imagine for a second, a 50-year-old male standard with a 2017 CSO life expectancy of age 84 at initiation, right? Standard non-tobacco male, age 50, is expected to live on average to age 84. So our initial expected return on this particular policy, thus the asset class, after tax, is 5.52%. Okay, very respectable return. Of course, there's 34 years between initiation and life expectancy. And we also know that the likelihood of this individual person passing away at age 84 is fairly low. But we also know that the IRRs, if you've looked at an IRR chart over time for life insurance, is that 5.52%, if the client passes away at age 85 and the payout happens at age 85 or 35 years into the future, that IRR is not going to drop from 5.52 to -5 in 1 year. We know that glide path is very smooth from around age 75 to age 95 or so. We know it goes down over time because of time value of money, but it's very, very stable, in and around. It might only move by, some basis points from 1 year to the next. So stable IRR glide path. Our expectation is 5.52% expected return on the asset class. And now, what I believe is the most important aha moment, a standard deviation, or the propensity for the probability that the IRR or the return on the asset class is going to vary by about 70 basis points plus or minus due to variation of when mortality actually occurs or maturity of the contract, as it were, right? So one could say it slightly differently. One could say there's a 68% probability, now that's one standard deviation, right, plus or minus, that the expected return on this asset class is going to be 0.68% plus or minus around the 5.52% expected return or mean return, as it were, right? So that's what the data is telling us, is that there's a 68%, just happens to correlate, 68, 69% probability that the return is going to be plus or minus 68 basis points around 5.52%. How many asset classes, if we think back, have that kind of stability from one year to the next, granted over very long time horizons? Well, very few, as we'll see quite shortly. But the power here you'll see, and the variations in the standard deviations are a function of time value of money or the IRR glide path, as it were, right? A standard deviation of just north of 1% on a 20-year-old, if you start the cycle at 20, you have a 62-year time horizon before you're expected to achieve a 4.75% rate of return on the asset class. And so the glide path of IRR is actually going to be a little bit steeper, as it were, compared to a 50-year-old because it's much, much longer, right? It's very steep in the early years. And so the standard deviation variation here, and from age 20 to 50 to 85, you'll see that the standard deviation goes up pretty substantially when you get into the older ages. Why? Because the variation in IRR from one year to the next moves more because the time horizon is much more compressed, right? A 75-year-old, the expected time horizon before payout on average is only 13 years compared to a 20-year-old where it's 62 years. So one can immediately see why the standard deviation calculated at initiation can vary depending on what the initial attained age is of the client. Nevertheless, ask yourself, if you think back on expected returns on typical asset classes, large cap equity value, for instance, and what the standard deviation is there, right? It might be a 6%, 7% rate of return long term with a 15% standard deviation. So there's a variation that's substantial from one year to the next. Having an asset class that at initiation, if the client's age 70, where there's a 16-year time horizon expected mean outcome before payout with a 7.25% after-tax return with a 2% standard deviation, how many asset classes can say that? Well, not many, if any. And that goes back to my point earlier about how the standard deviation mimics cash or short duration government credit, right? And those expected returns are substantially lower than what we see in life insurance. Now, I also mentioned that asset class suitability review is critical. And I sort of jumped the gun a little bit, so hopefully I've primed this slide here, that who are suitable investors for this? Well, first and foremost, if we're dealing with 40 or 50-year time horizons for younger individuals, and you know, as far as the life insurance policy, the construction part is concerned, you're talking about investors that have long and post-mortem investment time horizons, post-mortem to the underlying attained ages of those policies for which the policies are issued on those individuals, right? So clearly, as I mentioned earlier, if you have a portfolio construction technique where you're building a portfolio or an asset allocation for a client that's meant to grow the portfolio, but it's going to pay out or distribute capital to supplement retirement, for instance, then clearly investing in a life insurance policy in this manner on that same individual doesn't make a whole lot of sense, because they'd have to arguably pass away before that portfolio return is achieved for that portfolio. And if the purpose of that portfolio is to be a living benefit while the individual's alive, that's a natural clash. But there are a number of areas, in my opinion, and the rest of the industry's opinion, frankly, where this asset class fits and has a place. It's suitable for the legacy capital discussion, not lifestyle capital, right? So in a succinct manner, when you're talking to a family office or you're talking to a trustee, an endowment, etc., that they have very long to potentially infinite time horizons, or just a multi-generational portfolio as an example we'll see here in a moment, right? When you're talking about legacy capital, you're talking about the what's being transferred from one generation to the next. Clearly, this has a place, and we know that qualitatively. What we're trying to do is define it in the investment management speak, why it fits quantitatively as well as an asset class, and what it can do for the investment or the portfolio over that time horizon before it actually pays out, and as a buffer asset, as we'll see shortly. So some of those examples I mentioned, but legacy assets, multi-generational portfolios, spouses and children, they're looking for wealth transfer planning, family offices, trusts, corporations, endowments, anybody with a long and post-mortem investment time horizon, this could be a fit. But we also know that, a lot of people are chasing, or a lot of investment managers are chasing return. And so we also know that there are delimiters in terms of what an effective return can be on this asset class, because the only way to achieve higher than expected rates of return on life insurance death benefits is for individual people to pass away sooner than we have statistically calculated is the likely probability. And so that in and of itself has a benefit, particularly in key person and all those matters where a loss of life of a key investment manager or something like that, that could also be a fit. But generally speaking, financially or quantitatively, we don't want to bet on the idea that people are going to die earlier than what we statistically believe is the case to achieve outsized return objectives. What this asset class does as a buffer asset in the portfolio is that it fits very neatly within the context of fixed income type investing, right? So most portfolios will have some combination of equities, bonds, alternative asset classes, etc. I believe that this has a place in the fixed income world where you're seeing lower long-term expected rates of return, but lower standard deviations. And here perhaps is where you can introduce it into endowments, etc., that are going to have, in some cases, large allocations to fixed income instruments that they're planning to sit on infinitely. And every time a bond matures, they reinvest a portion or all of it back into new bonds at, frankly, in this day and age, at lower and lower reinvestment yields. And so that's where I think this fits perfectly. Kathy, this is a natural break. Are there any questions that are coming in that would you like to ask at this point?
I do not see any questions. The only question that was asked was that is this going to be available after the presentation? And the answer to that is yes. The webinar is being recorded and will be available on our YouTube channel, and the presentation will also, the slides will be available on the Agency One website. So with that, Chris, please continue.
Good news. All right, so let's jump into a scenario, because it all becomes very sort of ethereal when you're talking about it in this way, and but it does set the stage, hopefully, in going into kind of how would one go about doing this financial analysis and embed a life insurance policy to demonstrate quantitatively how the non-correlation factor, the low standard deviation, and the very respectable return on such an asset class fits into a broader portfolio construction framework. So let's imagine here that we have a husband and wife. The husband's uninsurable. They're 68 and 65. The wife is a standard non-tobacco. They have a $20 million stock bond portfolio split between stocks and bonds, diversified equities, diversified bonds, which is designated at this point in the planning process as legacy capital. They have other assets or income that they can live on. They do have some concerns, however, but they do want to transfer as much of this, or grow it and transfer as much as they can to the next generation. They are looking for options with increased stability and certainty, aren't we all, right? But they do struggle, or the investment kind of philosophy around the 50-50 is that we'd like to reduce the equity allocation because we see risk in that, but the alternatives, the more traditional alternatives of munis, CDs, short duration bonds, to tilt the risk down, or to move the risk overall, or the volatility risk in the portfolio down, it's just not generating enough yield today, right? And I think we've all come across this issue, is that bonds portions of the portfolio are increasingly dragging on overall performance, and we're in a risk-on world, and the risk has been that people take on much more risk than what they're ultimately comfortable with, and so people want to find an alternative. They have a risk aversion to heavier equity allocations, despite the expected long-term returns on equities being 5 to 6%, which is where they want to be, right? Around a 5 to 6% expected long-run rate of return is what they can stomach. But they also know that, if there's a way to achieve those return objectives longer term, while reducing the overall risk in the portfolio, they would be open to that discussion. So, desire to reduce exposure to volatility risk, we've mentioned that, and I throw in here general aversion to life insurance, as we come across that quite often in the industry. Is many people's minds can't compute how life insurance fits in the portfolio construction process, and that's what we're going to attempt to resolve here. Perhaps not with the client, but with the portfolio manager or the asset manager that's actually, reallocating the portfolio overall to try to do what's optimal for the client based on their risk tolerance and suitability. Let's first see where we are, right? To start with, we know that the clients have a $20 million portfolio with sort of 50-50 diversified equity, diversified bonds. Here I'm pulling long-term capital market assumptions from JP Morgan and BlackRock and sort of averaging them out. I'm going to reference some of the JP Morgan stuff. I'm sure you can pull information from other sources and you get slightly different numbers. But at the time of when I built this last year, JP Morgan's capital market assumptions stated that the long-term equilibria pricing or expectations on a diversified equity portfolio was a 6% expected annualized return with a 15% standard deviation, right? And a correlation coefficient between equities and bonds of about 0.06, so very close to zero, right? But again, that's a snapshot in time, and we know that varies through time. We also know that the risk-free rate long-term assumed is 2% on cash, okay? It's just plug here in terms of what your long-run expectations are and where you source that data from. But what the interesting part here is, if we're going to calculate the Sharpe ratio of that portion of the portfolio, we need all of those components. So the Sharpe ratio on the diversified equity portfolio side is 0.27. Now, Sharpe ratio is a risk-adjusted return metric. It's not percent. It's essentially the formula is you take the expected return on the asset class, you take out the risk-free rate. So in this case, it'd be 6% expected return minus the 2% risk-free rate of 2% cash long-term, divided by its anticipated volatility long-term. 15% standard deviation results in a Sharpe ratio of 0.27. And it can be measured in relation to other asset classes. And that's the important part, right? Is how is the risk-adjusted return expectation based on its volatility metric in relation to other asset classes? So namely, diversified bond portfolio is expected to return 4% with a 3.5% standard deviation, which results in a higher Sharpe ratio. But clearly, if the clients are expecting a 5% plus annualized rate of return long-term, we can't put 100% of the portfolio or tilt the portfolio 100% to bonds, because even though the Sharpe ratio is better, the risk-adjusted return is better, the Sharpe ratio doesn't tell us anything about what the actual expected return is, only what its return is in relation to its volatility metric, right? So higher Sharpe ratio is better, but it's only one tool to help you navigate, well, how do we achieve the return objective desired? And also, can we do it with a less amount of risk by inputting other asset classes into the portfolio with higher Sharpe ratios and still achieve that ultimate return objective? So hopefully that's clear. So let's look at it kind of more visually. And there's a lot of stuff going on this. I apologize on it because JP Morgan actually publishes the efficient frontiers of all asset classes that they publish data on through time, right? To show you how the efficient frontier over time is actually shifting from higher expected returns, similar risk, down, and it's flattening the curve. But pay attention to the 2019, the 60-40 portfolio here. And we want to know, okay, the client's current portfolio, $20 million, 50% into equities, 50% into bonds. It should land somewhere to the left of the 60-40 stock bond portfolio. And sure enough, it does, right? When we combine those two asset classes in a portfolio and run long-term capital market assumptions on that portfolio, what we get is around a 5% expected long-term return with about an 8% or so volatility metric, namely standard deviation, right? Here we see that calculation. I've extracted and just built my own model to demonstrate it just in the two asset class world. We see that a 50-50 stock bond portfolio based on those assumptions is expected to return 5% long-term with an 8% portfolio standard deviation. Now, we also know that the clients are worried about that 8% standard deviation, right? They still want the 5, but is there any way that we can still achieve or potentially achieve a 5% or more rate of return long-term with a lower amount of volatility risk? Numerically, the projections would be if we expect 6% on equity returns, and this is just a flat calculation, 10 million in equities, 10 million in bonds, but you'll see why I kind of combine it. Typically, we don't do this type of analysis of saying, oh, well, if we do get those returns, you're going to turn your $20 million portfolio into a $69.5 million portfolio 25 years hence, because the past is not indicative of future results, et cetera, et cetera. But we nevertheless want to analyze this because we want to see what the total capital balance variation looks like through time, because we know that the sequence of returns is not going to be a straight 6%, 4%, right? And that's where the clients become fearful. But we do nonetheless have to keep our eye on what the ultimate kind of total portfolio return objective is numerically, because we don't want to put in other asset classes in the portfolio only to see that 69 million only potentially be able to grow to 30 million as a result, even though we've reduced the overall risk. Then we haven't achieved both objectives of expected return and risk, higher expected return, lower risk combination. And we also know the clients are worried about the equity volatility portion of the portfolio. So the real question we then ask ourselves is, can we achieve a similar long-term rate of return, yet lower the range of uncertainty or lower the standard deviation? Well, here's a snapshot of my calculation tool that I've built to calculate both expected return and standard deviation on life insurance. I'm not going to spend a ton of time, as I mentioned, on kind of the mathematical framework. I'm happy to share it if somebody wants to talk about it with me over the phone or what have you. I would have almost said meet in person, but that's going to be somewhat challenging. But certainly if somebody wants to dig in more into the numbers, I'm happy to do so. But let's remember, our client here was a 68-year-old uninsured male and a 65-year-old female. So can we introduce a life insurance policy into the portfolio and achieve same rate of return with lower standard deviation or lower risk overall in the portfolio? Well, let's see. Let's imagine that we are proposing a $10 million death benefit policy for this female 65 standard non-tobacco. Again, I'm using our IUL Protect 50-50 blend indexed a fixed account rate, 5.06%. The important component here is we're doing a 10-pay at $375,000 per year, and the IRR at or expected return at LE plus 2 here. LE is age 88, so I'm doing the calculations based on age 90 mortality occurring. When you true it up in terms of a tax equivalent return, right, at 23.8%, cap gains rates, not ordinary income tax rates, we go from a straight after-tax return of 4.85 to a trued up rate of 6.36% equivalent, tax equivalent IRR on net death benefit. With an average standard deviation through time, because we need to do the standard deviation calculation through the entire period, all the way up to when the mortality tables say that 100% of people statistically would have passed away. So we calculate a standard deviation on this policy expected of just north of 1%. You'll see it down here as well as up here. So here's our output, right? LE is 88. We're doing calculations based on 890, 1.03% standard deviation. Okay, so now we have that component. Now we know what the expected return is on the asset class. We know what the standard deviation is on the asset class. And we know what the correlation coefficient of that asset class is compared to the other asset classes in the portfolio, right? Namely 0, because it's uncorrelated. So now if we present the alternatives to the client to say, you have 50-50 diversified equity and diversified bonds with these same Sharpe ratios, expected returns, and standard deviations. A $10 million life insurance policy on the female is a after-tax expected annualized return of 4.9% at LE plus 2. 1% standard deviation results in a Sharpe ratio of 2.9. So higher Sharpe ratio means better risk-adjusted return potential on that asset class. But like I mentioned, it doesn't mention anything about whether the actual return is sufficient based on the objectives of the portfolio. But here we see that that combination of low standard deviation, respectable return is outsized compared to the other asset classes currently in the portfolio. So where does that asset class sit on the efficient frontier then? Well, as we mentioned, it has similar volatility metrics to US cash and short-term government credit, right? There are very few asset classes that exhibit a north of 2% return or 3 or 4% return long-term with less than a 4.5% standard deviation. So can that provide a benefit, especially if it's an uncorrelated asset class to the other ones? Well, what we've ultimately done by introducing a third asset class, namely life insurance death benefits in the portfolio, is have we potentially kept the expected return the same and lowered the all volatility? Was that our ultimate objective here that the client desired, was lower volatility long-term, more security in terms of what the intended outcome will be? I think so. If we put a third, if we reposition the portfolio to say a third of equities, bonds, and life insurance, we've actually shifted the efficient frontier. So the blue one is the original 2 asset class portfolio. Now we've shifted the efficient frontier to the left and somewhat up as well. And where you want to be in efficient frontier analysis is you want to shift that optimal portfolio up into the northwest quadrant, right? That's where you're getting incrementally higher rates of return for smaller amounts of risk. And that's panacea if you have, a sort of an expected return in the 10, 12, 13% return with zero volatility risk. Now everybody would buy that asset class all day long and just throw everything else to the curb. We also know that life insurance death benefits can shift that efficient frontier, but we also know that life insurance isn't traditional in the sense of you can kind of put in money when you feel like it. You're going to have to fund this thing to achieve the objective. And there are elements of illiquidity to this asset class that make it not perfect for every circumstance. Right? So we got to be mindful, and we got to be mindful of our blind spots, as it were, in terms of where we position it. Nevertheless, for the right type of portfolio, this conversation can be extremely powerful. What have we done then? We've taken a 5% return, 8% standard deviation portfolio into a 5% return, 5.32% portfolio standard deviation, just by introducing life insurance into that portfolio. Here we see the two side by side. The current portfolio, 5.8, with a portfolio Sharpe ratio of 0.38. Remember, higher Sharpe ratio is better. Alternate portfolio, a third roughly. We've lowered the portfolio standard deviation while maintaining the same long-term expected rate of return and increased the portfolio Sharpe ratio substantially. So the question we got to ask ourselves once we step away from the numbers for a moment is, have we created an increasingly optimal portfolio based on the client's objectives? And I would say in my example, I built it for the purpose in mind. I would argue, yes, we have. And I hope that this presents a quantitative framework in terms of thinking about, this is a conversation for those more mathematically inclined or the investment managers or whoever it is where you want to have an edge in terms of how to communicate the value proposition of life insurance qualitatively and have the capacity to introduce it quantitatively within the modern portfolio theory framework that investment managers, portfolio managers, family office managers, CIOs, etc., talk about long-term expected rates of return on different asset classes. Hopefully it introduces another way to talk about it, and we see the immense value that it could present to a portfolio and increasingly achieve long-term objectives of the clients. Here we then see the portfolio projections. Recall I did it with the numbers. One important aspect of this presentation, this version of it, is that we also know that the clients wanted to start steering away capital from the equity portion of the portfolio because they were increasingly worried about the volatility risk. So here I'm doing something that may seem counterintuitive in that, how are we going to pay for this life insurance policy? We know that there are $375,000 of premiums due for 10 years to maintain that $10 million death benefit in perpetuity. Well, I would argue that since we're going to likely rebalance away from equity because the clients are increasingly worried about the equity volatility, why not take the premiums out of the equity portion of the portfolio, right? So we're hopefully reducing the amount of equity allocation through time. But of course, with a 6% expected return, eventually you're going to outgrow that $3.75 million of premiums that you've taken out. But it does provide an elegant solution to kind of kill two birds with one stone, to say, not only are we introducing an asset class in the portfolio that lowers the volatility, which is what you wanted, Mr. and Mrs. Client, but we're also going to increase that chance by reducing some of the allocation from equities and take the portion that we need to fund the life insurance asset class from the equity portion of the portfolio, again, reducing the overall allocation through time. So it reduces volatility and uncertainty of outcomes over time. And it creates an immediate legacy asset of 10 million using life insurance, right? Statistically speaking, financially speaking, we have no expectation that mortality will occur in the first couple of years, but it could. And should that happen, we know that the IRRs are astronomical, financially speaking, in terms of funding the overall portfolio, the capital infusion into the portfolio. We've created an immediate legacy asset of $10 million. And that's there should that event occur, no matter how statistically improbable, because we do know that it happens from time to time. But what does it do to the overall portfolio then? Well, we have essentially reduced the total return, dollar amount return, by about $1.5 million compared to the 50-50 portfolio that, remember, that was about $65 million or so, 65 and change. Oh, sorry, 69 and change, my apologies. And this one has an end path of 25 years hence of about $67.7 million, right? And again, there's also the conversation of increasing the death benefit from 10 million to 20 million, because one of the challenges we're going to have is the difficulty ultimately of effectively rebalancing the portfolio weightings effectively through time, because we have a static death benefit here. And you can do it by using option B and other things, but we got to keep our eye on blind spots, right? Is at initiation, we're looking at a third, based on the $10 million of death benefit legacy asset, 10 million in the equity portfolio, 10 million in the bond portfolio, right? So a third. But as the equity portion grows, as we expect, 6% annualized per year, and the bond portfolio grows, and the death benefit stays static, you'll see that by female age 88 or by year 25, you'll see that the portfolio weighting of life insurance actually goes down through time as those others grow. So there are some ways to mitigate that, certainly by changing the death benefit option is one option, but you're also going to run the risk of, if you want to rebalance substantially at some point in the future, the client would still have to be insurable at that point to potentially buy an additional $10 million of death benefit, perhaps a year 10 or 15 in this investment time horizon. And that may come with some risk of a chance that they're no longer insurable, right? Or they're too old, etc. So bear that in mind. So no portfolio weightings are not static due to no rebalancing assumption here in the example that I'm showing you. Now, hopefully that presents a static kind of scenario. What I wanted to do in addition to is really try to demonstrate, when we're talking about capital balances of total portfolios, when we actually introduce the varying actual historical returns to these sequences, because I think that can also is another way to demonstrate to investment managers that may be contemplating this but may not see the forest for the trees, is to demonstrate through historical returns analysis of what it actually does in terms of buffering capital balances in the total portfolio. Because we all know, as life insurance people, we all know that if the market goes down by 50% and you have a $10 million death benefit that's properly funded, so long as you've continued to fund it, that $10 million doesn't change because the market corrects, right? That $10 million stays in force so long as you fund it appropriately. So that's where the non-correlation factor comes in, right? And the power of that as a buffer asset. So if an investment manager says, yes, we've lost $5 million in the equity portfolio mark to market, But guess what? That $10 million life insurance policy that we funded some years ago and completed, that asset class remains at a value of $10 million until mortality occurs. But let's look at how that would look like in real time. So I've actually used S&P returns as a proxy for diversified equity, and I've used the Barclays Ag as the diversified bond proxy. So let's see first the 50-50 portfolio. And this is every time we do these types of analyses on equity market returns and bond returns, we do it against what our long-term, static return objectives or expectations are. It always blows my mind. It never fails of how much people, if they've just stayed in the market, how much better off they would have been, right? But we have to contend with the fear factors of down markets, and people have a tendency to pull money out of markets, etc. And investment managers have a tendency to pull money in some cases or reallocate money in portfolios because they don't want to risk losing the oversight and the management of those assets if they're seen as doing nothing. But many times you make the argument that the best course of action is to just stay the course for the duration and not look at the portfolio, and it will do just fine, right? But let's look at this with actual historical returns from 1994 to 2018 on the 50-50 example I showed earlier of 10 million in equity, 10 million in bonds. That with this historical return sequence in tandem between the two asset classes, not only would we have gotten just 67 or 69 million dollars of outcomes, but we would have actually grown the portfolio to almost 122 million dollars. Okay, but what we know is what clients worry about and what keeps investment managers up at night are the negative return years and the substantial ones. It's that fear of the unknown and what to do in times of market stress or market correction, right? Let's look what would have happened had we implemented the strategy of a third, a third, a third, as I gave an option, portfolio option number 2, is we would have seen the same returns on S&P, same return on the Barclays Ag, but we would have depleted some of the equity allocations in up markets and down markets. And what impact would that have had, a number of years going forward in time? Well, that $120 million portfolio would have only grown to $116 million if that was the actual trajectory, right? But I would make the argument that if you're an investment manager and you expect a portfolio to grow from $20 million to $69 million long term, and you achieve 116 in lieu of 122, all the while providing a buffer asset class in the portfolio to reduce risk through time, through those times of market stress, etc., to create peace of mind, I think you will still outperform your initial objectives as a result, and the clients would invariably be happy. I would take that side of the bet. But let's look at the differentials then between the 50-50 stock bond portfolio through historical sequence of returns versus the third, a third, a third equity, bonds, life insurance scenario, and what the capital differences are in terms of or capital balance differences are. And here's where I think this buffer asset and the psychology behind it is so powerful, right? In these down years on the S&P, you would have seen capital balances deviate. So had you not had life insurance in the portfolio and had that $10 million buffer asset class in the portfolio, you would have been down to about $48 million of a decline over time from sort of a high of $49 million in 1999 down to about $41 million in 2002 had you stayed the course. But the difference, if you had life insurance, because of the static nature of the death benefit as an asset class, your delta at the end of 2002 would have been $6.6 million. So again, to create peace of mind, to see in real time how this asset class can provide downside protection on total capital balances, create peace of mind not just for the clients, but for the investment manager or the CIO, can be immensely powerful. Right? Same thing we see in 2008. Of course, over time, based on the returns that we see in the equity markets long term, you will start to see negative capital balances, meaning you would have been better off in hindsight having a 50-50 stock bond portfolio. But the key for me, the sort of aha moments are the facts that when you have those uncomfortable conversations, whether with your investment committee or with the clients or what have you, is in down years, and what do we do? What do we do? What do we do? This thing is falling off a cliff. Do something. That can create peace of mind numerically also, and can create peace of mind for the investment manager as well. So hopefully those are a couple of different ways to demonstrate, with a real kind of example of how you can buffer capital balances, how life insurance and an asset class can fit in the quantitative framework of other asset classes, what it actually provides in terms of its value proposition to buffer overall portfolios, either by reducing the overall risk in the portfolio long-term, achieving similar return objectives, or potentially increasing the return objectives with slightly lower volatility metrics as well. And I think that's immensely powerful, particularly for people that are mathematically inclined, or where the conversation about the qualitative value proposition of life insurance as an asset class just isn't enough, right? It's not getting us our point across or get it over the hump with that particular person or that investment committee or what have you. So a couple of parting comments and musings. Hopefully it provides a quantitative framework to illustrate the stabilizing force of life insurance, or what it can have in terms of the stabilizing force it can have on total portfolio values, right? It can help reduce stress for clients during volatile periods. The DBs remain secure in the portfolio and buffer capital balances. It helps advisors manage client repositioning risk, or it helps advisors retain share of wallet through multiple generations. We know this, that when there are death claims, et cetera, the propensity for the next generation to stay with that advisor increases if there are other asset classes such as life insurance in the mix, because it's an emotional time. And we also know the statistics about the tendency for next generation, whether they stay with their parents' generation advisors or not. And the more you can kind of cement that relationship by introducing asset classes that bridges that gap and creates more stickiness with the next generation, I think is an important component to consider as well. It demonstrates to clients that declines in other parts of the portfolio are supported by alternative asset classes that are uncorrelated, right? It's not subject to the same market risk factors. We're all looking for alternatives to combine a diversified portfolio that will maintain non-correlation, or in a perfect world, negative correlation. We just know that's a bit of a panacea with market-based asset classes. And it's a differentiation strategy for advisors, really demonstrated in real time, right? And in times of stress, we can say, aren't you glad we actually put this in place? Now you still have that $10 million or $15, no, $20 million life insurance policy in the portfolio. That's remaining intact. You don't have to worry about that portion of the portfolio. Think about what you're going to do to reallocate the rest of the portfolio for the clients, knowing that you have a capital balance buffer of 10, 15, or $20 million in there. And it allows financial planners to address aversion to risk, right? It's one way that you can reduce the overall risk long-term in a portfolio, and do so, going in a sound mind, knowing that the correlation factor is not going to change from uncorrelated just because there's market stress, et cetera. And it can be used in combination with other options, such as traditional risk reduction techniques, such as increasing the bond allocation from the equity portion, similar to what target date funds do, right? Which attempt to reduce the overall risk to preserve capital as clients age through time. This could be another technique for certain suitable investors. All qualitative reasons for using life insurance as a stabilization factor can and should still be used, right? Provides tax diversification or even reduction overall on wealth transfer. It creates an immediate legacy asset or asset class in case of earlier than expected mortality, and it creates peace of mind, amongst many other things. What I'm attempting to do is just to say, let's define it quantitatively so we can speak that language as well using our products in the broader financial services industry. And I want to emphasize that this is one way to articulate the potential value prop of life insurance products, right? And it has resonance, particularly with financially or mathematically inclined clients. It has immense amount of resonance with hedge funds, private equity managers, engineers, people of that nature. And so this isn't a kitchen table conversation with the mom and pop that's looking to do income replacement, using term. Naturally, we know that. But I do think that the market today, is ripe for having this further discussion to push the envelope to demonstrate to the rest of the financial services industry that we have a seat at the table with this product. It has a unique value proposition within the context of how you operate in portfolio diversification and asset allocation, or even asset location. Let's not throw it to the curb because it hasn't been used before in this context. Let's find a way to mend fences, or ultimately break down those fences, or the aversion to life insurance as an asset class. And hopefully this is one way that you can have that conversation, make it your own. I think that's very, very important. And I want to end with saying that, in my opinion, the call to action here for all of you that are listening in, if you have clients, institutional investors, you work with endowments, etc. The more places we can introduce the dialogue, the better off we'll be, right? This is just me standing on a soapbox a couple of times a year. Hopefully it's helpful. But I think more than ever, when we're staring potentially deflation and low to negative interest rates in the face for the foreseeable future, without any knowledge, even less, more uncertainty, less certainty around what projected glide paths are going to be on interest rates, etc., that has a huge amount of impact on and bond defaults, etc., right? Huge potential long-term implications. This is a good time because I think now is the time for people to listen. Now they're primed to actually have this conversation, because everybody's scrambling to figure out, what does my portfolio construction look like going forward, when I know there are fewer and fewer safe haven asset classes out there that I can just plug and play. Now people are primed for that conversation. So that would be my call to action, and my key takeaway is the timing could not be better, in my opinion. So thank you very much. I hope you've enjoyed it. And Kathy, if there are any final comments from your side, or there are questions, I'll be happy to take those with the 4 minutes we have left.
Terrific. Chris, this was amazing. In the opinion of Agency One, you hit it out of the park. You delivered everything that we had hoped that you would. We asked you to speak today because we believe that this conversation is extremely timely, especially in light of what's happening today in the equity markets, and allowing our advisors to have a different conversation with their clients and prospects that hopefully helps to level the playing field and provide some assurances on a moving forward basis, is something that we believe is critical, and provides a benefit to everybody involved in the conversation. We do have a couple
concur,
questions.
and I can think of no better firm than yours, Kathy and Gonzalo, to help continue this messaging, and knowing the types of producers and audiences that you all get. I'm very thankful that you continue to think of me and my messaging as important to your group of individuals that you engage with, because I think it is an ideal place for this conversation. And I stand here with open arms, offering to help anyone individually to further this, to potentially make it their own. Because again, it's hard to kind of digest all this and say, okay, what do I do with it? I'm happy to work with people individually, should they want to, or had a desire to. So thank you very much.
Thank you. So we've got a couple questions, and if anybody has anything that they'd like Chris to address, please type them into the question box. The first question is, your IRR analytics as to life insurance are based on death only. On the new policies with accelerated death benefits for terminal illness, critical illness, and critical illness living benefit riders, these riders allow early payouts of portions on the death benefit. Doesn't this potentially change the IRR analytics substantially? That was question number one.
Okay, so it does change the IRR calculations, but I wouldn't go as far as to say that they would change them substantially. What you have to think of, and I've had this question before, I haven't done the analytics in terms of long-term care riders or chronic illness riders or accelerated death benefit per se, but if we think about it, it's an annuitization of a lump sum payment, right? And it can happen much sooner than the expected death benefit payout. So it should, in most scenarios, improve the expected return on the asset class. But we also, right, because if you're getting, in my example, the $10 million policy, and you have an accelerated death benefit rider that most policies have these days, and you have a terminal illness, and you can accelerate receipt of those death proceeds while you're still alive, and you can do it potentially several years before we expected the mortality to occur, and you do it in installments of, let's say, a quarter, that will improve the overall IRR expectation, right? But we can't bake that in based on statistical analysis. That's what the long run expected return is. But we can update it as we mark to market this asset class in the overall portfolio. And I would expect those IRRs to, if that occurs very soon after initiation of the policy, obviously the IRRs will be astronomical. But the delta between an acceleration of death benefit versus the actual lump sum payment, that difference between those two in terms of effective IRR on capital receipt will not be as substantial, I think, as you think, but it will be substantial because if mortality occurred 2 years into the policy, your IRR would be astronomical, as we all know, right? But the statistical probability is very, very low.
Got it. The next question is, in the context of multi-generational trusts, would it make sense to insure multiple or potentially all family members?
Yes. I would say the more you can build a portfolio of life insurance policies, the more you can spread the overall uncertainty around when mortality is going to occur. That's what life insurance companies do, right? They do the large of law numbers. They know that if they have a good mix of thousands of individual insureds, they know they don't have to be right on every single individual policy that, you know, this person's going to pass away at age 88, this is going to pass at 92. We know that there's no way to really, you know, manage that effectively. All we know is the older you get as an insured, the more likely you are to pass away, right? The closer you get to that eventuality. Similarly put, in a family office context, having a laddered portfolio of this asset class with multiple ages actually could be hugely beneficial to even further reduce the overall risk or volatility of that portfolio rather than relying on only a singular policy. But keep in mind, the likelihood of a 20-year-old, you know, passing away before age 88 or 89 is very, very low. And so you have that asset class now for 60, 70 years. If that makes sense in that portfolio context, absolutely. And I would say that it does have a place, but usually the conversation starts around the patriarch or matriarch or some combination thereof, because the time horizon to payout is maybe 15 or 20 years. And that, you know, is a capital injection to the overall portfolio sooner than having to wait 60 years for a potential payout. But absolutely, a laddered portfolio helps manage risk in this asset class overall, the more individuals you have with differing ages and life expectancies.
Thank you. That makes sense. We do not have any more questions. We are at the top of the hour. I want to take this time again to thank Chris and our friends at Equitable for their support, their friendship, their knowledge, and for this terrific presentation. If you've got any questions, comments, concerns, if any Agency One can help you in any way, please reach out to myself, to Gonzalo, to Dennis, to Ed, to any of your case managers or any of the rest of the staff at Agency One. And as I said when we started, this presentation has been recorded. If you'd like to listen to it again, the slides will be available on our website. We wish everybody a terrific afternoon, and we hope to speak with you soon. Thank you very much. And again, Chris, thank you.
Thank you all. Have a great rest of your day.